from. I feel like we're covering all the states of Australia. If there is anyone else out there that's from Adelaide and Perth too, and then the NT as well, we'll have it all covered. Awesome. We'll give it one more minute and then we'll get started. Amazing. So we've got Michigan. Feels like you're our only international audience. Brisbane as well. Gold Coast, lovely. Awesome. I think we might get started. So welcome everyone to this session as part of the Spilled Property series, How to Buy Your Second Property. A big shout out to Pivot Wealth and Raise for collaborating on this session. I personally like to say an acknowledgement on country. So GA Australia acknowledges the Aboriginal and Torres Strait Islanders peoples as the first Australian and traditional custodians of the land where we live, learn, and work, and we pay our respects to the elders, past, present, and emerging. Just a little bit about General Studley and who we are. We're a global tech education company empowering people to pursue the careers they love in tech. So that's from data science, software engineering, UX, digital marketing, product management. We teach all those courses from part-time, full-time workshops, and we also host these free community events. If you want more information about what we do, head to the website ga.pro for more information. So how you can participate today, I'm sure a lot of you are familiar with Zoom, but as you're watching the session, we'd love for you to chat and interact in the chat function, so you're all popping in where you're streaming from. So if you have any comments for our fellow attendees, pop them in there. Any questions for me, I'll help you out there too. If you have any questions for Ben though and about this presentation, please do use the Q&A function, so you'll see that at the bottom of your screen. And lastly, we'd love to see what you're learning and where you're joining us from. So if you're on Instagram, we'd love to see what you're learning. So tag us at General Assembly Oz NZ on your story, and maybe we'll give you a cheeky repost. But without further ado, I'll now pass it over to your presenter today, Ben, and take it away. Thanks everyone, and enjoy the session.
Thanks, Cleo, and g'day everybody. Pumped to be here with you today. My name is Ben Nash, and at Pivot Wealth, we help people with their money, essentially be smarter with their money so that they can live an amazing lifestyle. So today we're talking about how to buy your second property. Just before I crack in, can the people following along please just let me know that my audio and slides are coming through okay? Just pop that into the chat. Yep, thank you, Cleo, appreciate that. Cool, so before I get into it, just big shout out to the legends at General Assembly for putting this on today and hosting, and our event partner, Raise. Those guys, if you're not already around their stuff for both of them, they're doing some pretty cool things. So do check them out. And also, just for the lawyers, please, guys, do not rush out and make any life-changing decisions off the back of this presentation. We strongly encourage you to seek out some personalized financial advice before jumping in. Property is a really big deal, so you should be really doing that anyway. So, firstly, I'm just going to share a few numbers around why shares versus property and I suppose ultimately the power of property. Now, what I've got here is I've got $100,000, an example with $100,000 invested into shares at basically the 20-year historical share market return, which is 8.7%. So basically, if you invested 100K into shares and got that return, and while the past doesn't predict the future, I feel like it's fairly reasonable to expect that it's not going to be too different to what's happened in the past. But essentially, after 1 year in the market, you're going to have some income and dividends, basically $107,016. After 10 years, though, that you see that the compounding starts to accelerate, and you've got $197,000. after 20 years that would continue to compound. And this is assumes sort of reinvesting dividends into the portfolio and just allowing it to bubble away, that essentially it would now be worth 388,000. So you can see it's a pretty significant sort of increase there. And then after 30 years, it would be 764,000. So again, it's almost doubling every 10 years, which is great. And you see that, you know, from 100 grand, you've got $750,000, which is cool. 40 years, keep that going, 1.5 mil. So it's big numbers over time, and it shows the power of compound interest. But if you look at property, for example, and what I've done here is I've got a 6.8% return on property, which is essentially the 20-year return on Australian residential property. And again, the past doesn't predict the future, but I think this is a very reasonable expectation for what will happen moving forward. Now, you see that at 6.8%, a $500,000 property is growing $35,000 in the first year to be worth $535,000 at the end of that year. After 10 years, though, the property is almost doubled to $985,000, and then 20 years, 1.9, 30 years, 3.8, 40 years, 7.5, which is very big numbers. And if you look closely at the numbers, and I appreciate that there are a lot of numbers here, but that in each of these periods, in both the share and the property examples, we're basically getting a doubling. But the power of property over the power of shares is that if you had $100,000 in the bank today, you could choose to go and buy a share portfolio, and as you can see, you're going to get some great outcomes. But if you were to get that 100,000 and use it as a deposit to buy, say, a $500,000 property, you see that the profit that you get is significantly higher. Like the profit on the share portfolio is like $1.4 million over 40 years, whereas the profit on the property investment is like $7 million over that same time period. So while they're both good investments, you see that property is a winner, and really it's the leverage or borrowing, gearing, which just means borrowing to invest, is the key driver of the returns that are there. So today, what I'm going to do is I'm going to help you unpack some of the things that you need to be aware of when it comes to buying property, how you can make it happen, and how to set up a rock solid property strategy to start using that leverage to really accelerate your asset building and wealth creation. So look, when it comes to property and when it comes to money generally, that there are some really common challenges that people face. We see this a lot, especially because property is such a big decision that, you start doing your research, and then you're sort of like overloaded with information, that there's so many options, too many options, too much information. And it's like you're drinking from the fire hose, that you don't know who to listen to, who to trust. Property in particular is one of these areas that is a real, there's a lot of sort of conflicting points of view, mixed messages, but also some hidden agendas. And certainly we've seen in the past a lot of people sort of going really wrong with property and them causing themselves headaches for years to come. The second one here is that people, when it comes to property and your money overall, that people really struggle to find the right balance between getting ahead with your money and also living a good lifestyle. So finding that, how much do you push to get ahead and build up those dollars or your asset position versus how much can we just enjoy, so that you, like I say, find that balance. And then the third one here is everyone knows FOMO, the fear of missing out. We're seeing a lot of that in the property market at the moment, driving a bit of crazy behavior, really. But then there's the fear of effing it up, essentially, where people with property, it's such a big decision. You should be doing the right thing, but you're not sure what that right thing is. And so you end up basically doing nothing, and that leads you to is getting stuck. And it's stuck, not always stuck doing nothing, but often stuck just doing the same thing that you've been doing in the past, and you're essentially sort of spinning your wheels without getting any results, and ultimately missing the opportunity to start really building your money momentum, or as much as you can. So what we've found over the years from helping a lot of people with this sort of stuff is that there are 3 elements that you need to get right in order to be successful with your money and successful with property. So the first one that I've got here is your structure, which is all about making it easy to save and making it easy to manage your money. Now, that's really important when you buy a property because it is a long-term commitment generally in that it's expensive to buy and sell. So you don't want to buy a property and be forced to sell it the next day. But so you need to make sure you got your numbers right and make it easy to save and manage your money, yes, but let's be crystal clear on what money you do have to work with when it comes to investment strategies, paying down debt, buying property, all of those sorts of things. The second element that I've got here is your strategy, and that's all about really understanding the pathways that you've got available to you to take you from where you are to your version of money success. Now, there's no one set of steps that every person can take to deliver them to money success, because the right strategy for you, it really depends on you. It depends on where you're at now. It depends on what's important to you, and it depends on how you see your situation changing over time. So having a good strategy involves sort of understanding what your baseline is and then making sure that you're layering the right financial decisions over the top of that strategy to deliver you the financial results that you want while you live the lifestyle you want. It's a key to that balance thing that I was just talking about. And then the third element that we've got here is your solution. So it's all about having rock solid investments that deliver consistent, reliable progress and avoid the chances of those downsides and setbacks, the momentum killing mistakes. So each of these elements are powerful in themselves, but if the power of them combined is significantly more, because if any one element is missing, it ends up dragging down on the others, and and ultimately don't get the results that you want. So you really do need to get all of them right. So I'm going to crack into the property leverage and key things to think about, and how and why buying your second property is something that's important. But before I do, I just want to run through some of the money stages that that people go through. And essentially, there's a bit of a progression here for anyone that's been following along on this series. You may have seen this one before, but essentially it goes through the different stages that people go through with their money. And what differentiates the stages, there are 3 key sort of elements, I suppose. The first is how quickly you're getting ahead with your money. The second is your ability to live the lifestyle that you want. And the third is how you feel about your money, your peace of mind levels, confidence levels, stress levels. So the first stage that we see people in is this distressed stage. And for people that are distressed, they essentially they're not making any progress at all financially, and in some cases even going backwards. They're essentially, from a lifestyle point of view, they're trapped because they've got no money to make the personal or lifestyle choices that they want. And from a peace of mind point of view, understandably, they're stressed out. I assume for people on this session that looking at buying your second property, most likely you push through this stage. But the key to getting out of the distress stage is that you can't do that without making a commitment to your money. Money is a thing that is really important, but it's never really urgent. So it's easy to you want to do some stuff, but then life gets in the way. The inbox fills up. You got personal life to deal with, and it sort of goes on the back burner, and then it just won't come together on its own. So you need to make that commitment. The next stage that we see people in is a stalled stage. And for people that are stalled, it's where they're making some financial progress, but it's slow and slower than they would ideally like it to be. They're from a peace of mind point of view, they're not fully stressed out, but there's like this niggling sort of thought in the back of their mind that there's opportunities that they're missing out on. And then the next stage that we see people in is this comfortable stage. And for people in the comfortable stage, they're now building some serious momentum. From a lifestyle point of view, they're able to live the lifestyle that they want, and finding a good balance between living the lifestyle that they want while they make the financial progress that they want. And from a peace of mind point of view, building up some serious confidence. The next stage that we see people in is what I've technically called the killing it stage. And for people in the killing it stage, that's when you're really now making some rapid acceleration from a financial perspective. From a lifestyle perspective, there's no limits on what you can do because you've got plenty of cash to support that. And then from a peace of mind point of view, you're feeling completely carefree. So it is a progression, guys, as you can see, that there are some key things to do to progress through those stages. So the first is making that commitment. The second is about taking ongoing action. And this is something that, especially with property, and when you get into that serious level of asset building and wealth creation, you need to do stuff. It's not going to just happen. So you need to take some action. But because everything is changing so quickly, what's important to you, what's going on in the world, what's going on in financial markets, you need to take that action on an ongoing basis to make sure that you're continuing to get the results that you want. And then the key to getting from the comfortable to the killing it stage is making sure that you're maximizing every single opportunity that's available to you, squeezing every bit of juice out of your situation so that you're doing the right thing with your mortgage and debt. You're optimized from a tax perspective. You are doing the right thing with your investments, your super, all these things, all of them combined, because that's what really delivers you that serious acceleration. So for the guys watching along, I won't get you to say where you're at, but can anyone identify with any of those stages? And also, just in saying that, there are some. Thanks, Zoran, you're saying you stalled. There are some, sometimes you can be in different stages with different parts of your money. Like you might be feeling okay at some, but less okay in others, and different stages coming through. But it is a progression. There's some key things to get through to get through. I'm going to step you through some of those tactical things today. So property, the why and the how. Now, what I've got here is a bit of the how, as in if you want to buy your second property, how do you actually do it? And I've got some numbers here around an example for someone that wants to buy a $1 million property. It could be your home or it could be an investment. And I need to call out that it is a little bit of a moving target with how mortgages work and that sort of stuff these days. But essentially, basically, the bare minimum that you can put in on a deposit really is around that 5% number generally. So for $1 million property, and you can apply this to any value of property, but I've used $1 million to make my maths easy, that you need at least a $50,000 deposit. The rough costs, and I'll dive into a little bit of what makes up those costs, is generally 5% of the property value. So on $1 million property, you're looking at something like $50,000 to get into that $1 million property. Lender's mortgage insurance, again, it depends on sort of almost the day of the week and the lender that you use and stuff, but about $20,000 on a $1 million property. So the total deposit that you need is your $50,000 deposit, your $50,000 would cost an LMI, a total of $120,000. That gets you into a $1 million property. If you want to buy that same property and do it in a way that you don't have to pay lender's mortgage insurance or LMI, which you've probably heard about if you've been following the property market for a while, that lender's mortgage insurance is something that applies when you borrow more than 80% of the purchase value of the property. So in order to avoid lender's mortgage insurance, you have to put in a 20% deposit, which on this $1 million property is $200K. Your $50K costs are about the same. No lender's mortgage insurance or LMI here. So the total amount that you need is $250,000. That's a big chunk of change, clearly. So how do we actually get there? Oh, my slides are a bit whack. I'm going to show you that in a minute. But I'll show you. Before I do that, I just wanted to share that sort of the past and future of property prices. And I've looked at the median house price growth over a 25-year period. I basically found this study that went from 1993 to 2018, which is a 25-year period. And in that time, we've seen the median house price increase from $94,000 to $445,000. In the last 3 years, though, we've seen some pretty staggering growth, and that's now increased to $1 million. If we extrapolate that same growth rate out of 6.8%, which is the historical growth rate on property, that in 10 years from now, the median house price is going to be about $2 million. And 10 years beyond that, the median house price is looking at something around the $4 million mark, which is pretty staggering. Now, keep in mind that in 2041, your latte is probably going to cost you about $20 because of inflation, but you can see that it is a really significant increase in property that's expected over that time. So the sooner you get into the property market, the sooner you benefit from this. And I was actually chatting to a guy the other day from he's a well-being officer for a sporting club, and he was saying that he knows, and rightly so, that the key to having some level of a solid level of financial success is having some property investments in place, because ultimately you need somewhere to live. The leverage that we've spoken about, along with the house price growth over time, means that you're really sort of shoring up your financial future by getting in. And like we've seen in the last sort of 12 months in particular, that the price keeps running, and if you the longer you wait, it's harder and harder to get in. You got to save more, bigger deposit, more money, and the market just keeps going. And look, COVID has seriously disrupted the property market, but my personal view is I don't believe that in Australia we've got an amazing country, strong population growth, a strong economy, that is going to change significantly anytime soon. So I hope you found those numbers helpful. Now, I just want to touch on how we actually get, I think I have my slides a little bit out of order there, if I'm being honest, but I just wanted to touch on how we actually get that $1 million property example that I mentioned just earlier, that for $1 million property, we need $250,000 in deposit and costs. And for people that already own their first property, so long as there's equity in that property, you can borrow against the equity to fund your purchase. So if you have, say, a $1 million property already, the banks are generally happy to lend up to 80% of the value of that property against the value of the property, secured against the property, essentially. So if your loan was, say, $500,000 on a $1 million property, the difference, or the equity in that property, is $500,000, because it's worth $1 million. When you take the loan away, you get to a $500,000 net asset after debt value. Because the banks will lend up to 80% is $800,000, that there's $300,000 of what you would call available equity that you can use for your second property purchase. So in this instance, if you wanted to purchase this $1 million property, the $250,000 deposit, you would just secure against that equity. So it's a bank, there's like a whole legal stuff that happens behind the scenes, but essentially the bank say, well, we know that your other property is valuable, so we can borrow here, and then the remaining $800,000 that you need to borrow, you just secure against the property, because on the $1 million property here that you want to buy, the banks are comfortable to lend up to $800,000. So I get a lot of questions from people around equity, like how to actually use the equity in your property. But what this show, and for anyone that's following along, if you've got any questions, pop them in the questions box. I'm going to get to questions as we go through and also at the end. But essentially, what the equity release means is just a legal process where you can use the value of your property. And you see in this instance, you've outlaid literally $0, and you've now got this $1 million asset that is working for you, that's in your corner and helping you to get ahead. And if you go back to our examples around this property, you can see the potential that comes from that. So that's how the equity release works. In terms of the purchase costs, and just to break down the costs that you have, there are some core costs and then there are some optional costs, but essentially the stamp duty on a property, whether it's your home or an investment, is generally for around 4%. It's state-based, so it depends on the states. I know in Queensland it's a little bit lower, WA is a little bit lower, Sydney and Melbourne are about the same, around that 4% mark. Then you've got your legal fees, title searches, and insurance on your property. Those generally come up to about 1%, which brings the total purchase price to the total purchase cost for the core costs to 5%. The optional purchase costs that you may choose to incur as a result of your property purchase are lender's mortgage insurance, which you can choose to, depending on what your deposit looks like, up to 2%. Property buyer's agent, so that's someone that will go find a property, give you a short list, help you negotiate, help you secure the property. They can charge up to about 2% of the property value as well. But it can be a really good service, especially with the market being so hot at the moment, that they can really save you a lot of time and a lot of heartache in some cases as well, and get you into that property that you want, or secure that property that you want for you sooner. And then the other thing is doing a financial plan around that, which obviously my totally biased opinion is a pretty good idea, but choosing to get a plan around that. And I'll talk a little bit more about how you can plan, or what a property plan actually looks like as well. Before I do, though, I just want to cover off on some of the property mistakes that I see people making in this space. And there's a few doozies, and property is such a big decision and such a big purchase that if you get it wrong, it causes heartache for years. I know I've personally purchased an average property when I was back, just sort of finished uni, and it didn't do badly, but it just never did well. And I held it for about 7 years, and the whole time it was just a frustrating thing. And it also stopped me from buying other properties, because you can only borrow so much money. So you want to avoid these mistakes and make sure that you get your property strategy right. So firstly, important to note that when it comes to property, and I suppose all money decisions, that you can only really manage the risk that you understand. So what I mean by that is that if you don't know where risk is coming from, it is really difficult to manage that risk. It's only once you need to firstly go, well, this is where risk is coming from. This is where, and these are the things that I can do to manage it. Now, ultimately, risk is what makes you money when you invest. You know, there's risk in buying property. There's risks in buying shares. There's also risk in doing nothing. So when you're going down a path, if you want to do it in a way that that you're confident in, and you're confident to follow through on, and to make sure that it's a smooth ride, you want to understand where all of those risks are coming from, how you can manage them, and then what risk is left over, so that you can decide what risk for you is acceptable and what risk is unacceptable. If you don't do that, then you're either going to, one, be hoping for the best, or two, you're going to be just really scared, and sometimes you're going to find it difficult to actually pull the trigger and make that purchase actually happen. Next one that I've got here is understanding the difference in offset versus redraw. And what I mean with that is that there are some weird, quirky tax rules around property that say that there's a difference whether you put money in an offset account versus have it in a redraw. And what I mean by that, and where this actually comes into play, is that if you buy, a common situation that we see is people buy their first home, and they think they're doing the right thing, and they want to pay down that debt. So they furiously pay down their mortgage, and they know that the money's available in redraw if they need it, but they pay down. And then after a while, they might want to get their next property, whether it's upgrade their home essentially. Now, when you redraw from a property and then use that to purchase another property, your loan comes back up to the original level. But if you want to keep your first property, which is a common thing because you build a bit of an emotional attachment to this property and it's a good property, that's why you bought it in the first place, that If you move out and make it an investment property, normally the interest on investment property debts are tax deductible, but because any amount that you redraw is not for the purpose of investing, but instead to purchase your own home, it means that that debt is not deductible. So you can end up missing out on thousands or tens of thousands of dollars of tax savings each year just by getting it wrong. An offset account, in contrast, is just a bank account that's linked to your mortgage that you can put money in. The loan value always stays the same. It doesn't impact the loan value. It just offsets the interest that you pay on the loan. And then if you want to buy another property or a home in the future, you take the money out of the offset, put it into the next property purchase. Your loan has always been the same, so the whole loan ends up being deductible or remains deductible. So it's a nuanced thing, and it's a weird quirk of the tax rules that it's like that, but it is an important one. And I've seen a lot of people, you end up in a tricky situation where you pay down your debt, then you rent out your property, you're paying tax on the rental income that you receive on that property, and ultimately you're just giving up free money and got a higher donation to the ATO every year. So that's a really simple one to get wrong, but a really powerful one if you get it right. Understanding lifestyle risk is another important one. And what I mean by lifestyle risk is the risk of you buying a property and then your lifestyle changing or evolving to a point that the property that you purchased no longer fits with that. And I've personally seen a bunch of really sad stories that people have done this thinking about not thinking ahead, and they end up with this great property, but it's a property that just does not fit with the lifestyle that they want to live. Then you're selling and rebuying and incurring all of the costs that go along with that. So to avoid lifestyle risk when you purchase property, you want to look ahead and see what are the things that are coming up that might impact whether the property purchase is a good one for you. Things like having time out of the workforce, families, kids, childcare, schooling costs, all of those sorts of things. You want to factor them into the baseline so that you know when you layer a property investment decision over the top that it's going to be one that is going to be suitable for you not only now, but into the future. Making choices in isolation, and this is something that's somewhat related, but around when you make a financial decision or investment, you look at the decision in isolation, and it could be a really good investment, but it's not an investment that fits well with the other things that you want to do. So I've had situations with like share investments with clients where they're kicking butt, but they're locked in for a period of time, and then the situation changes, they want to buy property and they can't do it because the investment is there and it's not performing. It's just not the right thing for them to be doing. So when you're looking at your property purchase decisions, your investment decisions, your savings decisions, you need to look at them holistically to make sure it's not only a good things in individual sense, but that they all fit together and work for you. Seeking the best option is something that we see a lot with property, and it's often from the more analytical type people, engineers, teachers, that sort of stuff, that you've got these spreadsheets, you crunch your numbers in spreadsheets, you're trying to figure out the very, very best possible thing that you can do. And in the meantime, you're missing the opportunity to actually get ahead. We have working with a client at the moment that's got stuck in this and just couldn't overcome the mindset around it. And we've been looking at knowing that we wanted to buy a property and trying to make it happen for like 18 months. And in that time, the property market's gone up like 25%. So they've sort of missed the opportunity. They'll still be fine, but they've missed the opportunity because it's too much going on. It's this that my 27th box isn't being ticked on this list. So sometimes you got to settle for something that's really good and then just use that opportunity to actually create momentum instead of missing the boat and letting the market run away from you. Unconscious prioritization, and this is something that's more so from a not property, but it impacts your property in that we are constantly prioritizing with our money. We prioritize a holiday over a savings goal, a property over a holiday, sending kids to private school versus saving a bit more, investing a bit more, or whatever. Like these are all priorities. But what I find is that it's easy in the moment that you're down in the weeds and you think you should be doing this stuff, and you're like, yeah, that's good. And then spending makes you feel good in the moment as well. So that creates another challenge, and you end up unconsciously prioritizing. So what you're doing is that because you're just doing stuff, you are prioritizing, but you're doing it unconsciously. So we find that when people go back up and make their decisions at a 50,000 foot level, they make much better decisions, and ultimately they get better results, because you can be more objective with what your priorities are, and then you make sure that the decisions that you make and the things that you do are consistent with those priorities. It sounds small, but it is a really big one. And then the last one, and this happens a lot with property, people get the wrong advice. It might be your parents, your neighbor, your mates around the water cooler in the office, or it could be a bad advisor. Property, talking about the first three first, that no one knows what's right for you. The right thing for you, as I mentioned before, depends on you, how your situation is going to change over time, what's important to you, etc. So no one else knows what the best thing for you is. And a lot of people say, oh, you should just buy an investment property, you should just pay down your mortgage, you should just put it all into your home. All of those things can be good or can be not good. Whether they're good or not depends on you, as I said. So don't listen to other people, because they're not the ones that are on the hook for this massive property purchase that's going to be something that impacts your life for years or decades to come. Talking about advice for a second, and I'm really passionate about financial advice and good quality advice and support in a lot of areas. And I've seen a lot of people go wrong with property because of the conflicts and the commissions that people can get for recommending property, and SMSF strategies and all this sort of stuff. We unfortunately see way too much of that at Pivot as well, where you get caught up sold on an idea, and you really want to get the results, but you sort of blinded by, I don't know if it's greed, but it's the opportunity and your desire to shoot the lights out. But ultimately, again, property is something that impacts your life for years. If you get a dud, it's a total nightmare. So you don't make sure that you're taking that advice with a grain of salt. Be objective, understand how people are getting paid, why, and think about how that could impact what they're telling you. And again, I'm totally biased because it's the way we do things, but fee for service advice, where you pay a fee and you get a level of support, is in my view the best way to go, because when people are getting paid more, the more you spend, or when you buy properties and stuff, it just means that there's a huge conflict that exists, that even if it is good advice, you're probably not going to have the same level of confidence in. So getting that right is something that's really important. So how do you actually build a property strategy? Well, there are some key things for you to be thinking about, investment versus owner occupier. And I've actually got an example to share with you around that. But how much to spend and borrow, there is a difference because of the tax considerations here. So you want to make sure that you're understanding each of those options and what they look like, so that you can make the very best decision. How much of a deposit to use is a key one. Again, it's going to drive the cash flow impact, as well as the tax, how much money's left over for you to save and invest and pay down your debt after the property purchase. Where you should buy a property. Now, this is one that I get a lot of questions about, but really, ultimately, property is driven by supply and demand, like a lot of markets. And the things that impact demand are desirability of suburb, the aesthetics of the property, proximity to schools and hospitals, and that sort of stuff. But ultimately, the biggest driver of demand is population growth, and where the population is growing now. Migration and the property market has run hard without any population growth in the last little bit, because of partly record low interest rates and partly a few other factors off the back of COVID. But the demand is, you want to buy properties in areas where the population is forecast to grow strongly over time. Now, there's a lot of data out there on this stuff. The ABS put this out. Some of that is a little bit hard to read, but you can find reports that do sort of decipher those numbers and stats. And if you look at where the property is going to grow, then you know that demand will be supported over time. So in the major cities, it's generally those inner ring suburbs that are big growth areas. And then, Sydney, Melbourne, Brisbane, around the capital cities, WA is one. Population growth pretty nominal in Adelaide, although it is there. So look at what that population growth looks like. Then that's only half of the equation, though, because if we think, I was reading an article the other day about Northwest Sydney and the population growth that's expected there. But the population is growing fairly rapidly out there, out sort of Kellyville, Rouse Hill type way. But the supply is huge as well. That there are thousands or tens of thousands of new properties that are going up there. And what that means is that the supply is high, the demand is high, the supply is high as well. But if you think of it, the same report actually was talking about a bunch of suburbs, I think, like Fairlight, Clovelly was one, that these suburbs have no new properties being built. So the demand is high and the supply is stagnant. So those properties are desirable. And a lot of those, that's the inner city suburbs are more strict with their development pathways. So understanding what those look like and think about how that's going to impact your supply. But ultimately, in my view, it doesn't really matter if you buy in Fairlight or Mossman or Surrey Hills or Redfern. And these properties are all got strong growth. So they're all going to perform sort of similar. And that, going back to the seeking the best option conundrum, that's looking at taking action and getting some momentum is going to be significantly better than waiting forever to find this best thing that we don't know about till after it comes. Balance between your home and non-home assets. Guys, I can't stress this enough. This is literally one of the biggest things, the thing that has the biggest impact on your actual level of wealth. So a lot of people, and because property is expensive, and especially I'm based in Sydney, that the Sydney property prices are out of control, and people like, you're earning a decent salary, you're sort of saving strongly, and you're aspirational, and your mates in the office are, doing some things as well, and you think you should be doing those things. But when you look at buying a $2 or $3 million home, you've got to look at your ability to pay down that whole mortgage and then build enough other assets to allow you to actually get ahead and be financially secure. Because while it's lovely to have a lovely home, the home is not something that's going to give you any money ever. It's a thing that costs you money. So if you intend to live in a property forever, then there's almost no financial benefits that come from that. Obviously, your asset position is growing on paper, but there's no like true wealth benefits in that, because you can't eat a brick out of the wall. So when you buy a property, and when you buy your home in particular, just striking that perfect balance is something that is really mission critical to your true wealth position. So take the time to understand your numbers, think beyond just that purchase, and you'll be placed to find the right balance. Understand as well that if you want to buy your dream home, there can be stepping stones to get there. If you need to buy an investment property, buy a smaller property, live in a smaller property for a while, and then sell them up and get into your ideal property, that's totally okay. So you don't have to go guns blazing and stretch yourself to the max, and then you're eating baked beans every day for years because you think you need to. You can start smaller and build up to it over time. How practically you actually plan with your money, and this is the planning process that we use with our clients, but it's the same process that anybody needs to follow when you're buying property, is the first one, you got to focus on what's important to you. What are the key considerations? What are you on the, what's important to you, what's not? Then understand all of the moving parts, all of the things that are going to impact your strategy over time. So what money's coming in, what money's going out, where's it going? Where are your investments? What, any other mortgages, debt, asset values, equity, all of those things, because they're the things that are going to impact your strategy. And that's what comes next, which is exploring the different pathways that you can take. You can buy an $800,000 property or $1 million property or a $1.2 million property. What do those look like? Or if that's going back to what I was saying about your home, if you buy at those levels, what does that mean for your ability to do other things beyond your property purchase? When you talk through those options, you need to sort of educate yourself about what's driving the numbers so that you can have confidence in the decisions that you're making as well. And once you've chosen, what happens here when you do go through those scenarios is that you're generally more drawn to one than the other. And once you know what that is, you just need to put it together into an action plan where you know you're doing all the right things, that you're clear on what's going on, and that you've got the roadmap. Then automate as much as you possibly can: mortgage reduction strategy, investment strategy, saving strategy, all of those things. And that will allow you to set your default strategy to success, knowing that you're not going to be getting caught short for any of the, and not going to get let life get in the way and push you to do too many things. Because the more we have to do, the more you can forget, not do, muck up, do the wrong way as well. So that automation piece is key. And then once you've got your strategy, you want to make it happen. And I think it's really important for everyone here that once you've got a plan, it's great to have a great plan, but what's going to deliver the dollars to your bank account is the results and outcomes. So what you want to be doing is checking in with yourself, going back to that triangle diagram that I showed. It's that ongoing action. So, every month or 6 weeks that you check in, what's going on, how's it going, what's working, what's not working, what are the opportunities, let's stay on top of things. And then I would suggest that at least once a year, you go back through the process so that you continue to be on the front foot and taking advantage of all of the opportunities that are available to you. If you do that, you're going to have a rock solid strategy, but have total confidence in it and ultimately get the results that you want. Now, COVID's changed a few things, but the impact, I think, around what's going on at the moment is that you want to have a plan. Even if you plan fast, if you act slow, is what I got here. And it's knowing that you've got a plan in place and you're doing everything that you can goes a massive way to having peace of mind and what your peace of mind in what you're doing. And don't not act out of fear. The fear is something that holds a lot of people back and means that it paralyzes you. You don't take that action. And make sure you've got solid defense in place. We've seen a lot of disruption in the world. What's going on? You want to make sure you've got a good emergency fund in place, all of those sorts of things, so that you don't have to, you can get the results that you want without having to stress out about it. And obviously, the more, like when it comes to property and what you've got going on, the more complex things are, the more value there is in getting good help. So don't be afraid to seek that out when the time is right. Just one last thing I'm going to share with you, some numbers around a scenario for buying an investment property. And I've got an example here with somebody that's on $110,000. I've got their living expense, including tax, $60,000. The rent on this property is so they buy an investment property, and it's a $500,000 investment property, and the rental income each year is 4%. The mortgage costs are $21,000 a year, and then the ongoing property costs at 1% is $7,000 each year. The rental income that you get on that property is $28,000 a year, and net cash flow being $30,000. Now, if you look closely at these numbers, you can see that the rental income at $28,000 a year is the same as the ongoing property cost. So here, you basically get a property without paying any money for it. So it doesn't need to be something that costs you the world. And that's why when you're already on the property ladder, that you can use that equity and leverage to really get ahead and almost get a bit of a free ride. Now, guys, the interest costs are low at the moment, so you need to plan for what comes beyond this. But this example can help you see that you can really, it makes a lot of sense. As long as you've got the right defense in place and you can afford it and all of those sorts of things, it makes a lot of sense to be looking really closely at this. So guys, next steps. Look, I've got this quote here that I like to use in my presentation from Derek Sivers, and it says, if information was the answer, we'd all be billionaires with perfect abs. And what he means by that is that you don't need more ideas. Here, we've got enough ideas already. What you need to get results is you need to take action. So if so that's the key driver of actually getting outcomes. So guys, I hope you've enjoyed that. Look, if this is obviously exactly the stuff that we do. So if you need some help to get started and suppose get things moving, feel free to. I'm going to drop a note into the chat box here. And if you want to have a quick chat with one of our people about how you might be able to utilize the learnings from this session to get results, it's basically a 15-minute chat, no cost to you. We cover the cost of that, help you get clear on your next steps, opportunities for you, and also coming up to the end of the financial year, make sure that you're on top of things for tax time. So guys, feel free to get around that if you like. The link is in the chat box now. And I'm just going to cover any questions. So I can see a couple of questions here. If anyone has any other questions, feel free to please pop them into the Q&A box. Got a question from Mila here, which is, in using the equity release against existing property example, is there usually a higher loan rate applied by a lender for loan 2 due to the higher risk nature of loan 2 being secured by the property? Mila, the answer to that is no, because there is no, it's not a higher risk. The nature of the loan is not higher risk, because on the first loan, you've got 80%, you've got up to 80% borrowed, and on the second loan, you've got 80% borrowed. So there's no additional risk to the bank in doing that. In fact, in that particular example, the risk was slightly lower for the first loan because of the fact that it wasn't drawn right up to that 80% level. Got one from Jessica here, just saying, what report is this for the property? I actually think it were, I'm not sure who did the report, although I assume it was probably like Core Data or something like that, but it was on SMH. So if you just Google SMH, number of new properties being built in Sydney, I think you'll see that there. I hope you find that helpful, Jessica. Another one from Mila here is, how do I figure out the exact amount of available equity in my first property? Can be a rough estimation like different BW, current property valuation and like loan 1 amount, or do we have to agree on the exact equity amount with the lender ahead of getting loan 2? Oh yeah, I see what you're saying here, Mila. So how that works is if you do want to do something like that, what generally happens is that you will go to the bank and you'll ask them for a valuation, and they just send someone around, check out the place, and they'll put a formal value on the property that you already own. That formal value, once you've got that, you can generally assume that the banks are going to be happy to lend up to 80% of the value of that valuation. Now, importantly, and one thing I actually probably should have mentioned this before, but when you go to do a loan structure like that, you still need to be able to service the loan. So the banks are going to ask you a bunch of questions about your income, your expenses, your job security, are you on probation, all of these things, and you have to be able to service the debt. You can have $10 million in property equity, and if you don't have an income, or you don't have the income that the bank needs to service another loan, they just won't lend you the money. So you do have to be able to service, but once you get that formal valuation, they'll just lend up to basically 80% of the property value. So hope you found that one helpful, Mila. So guys, that's all the questions we got. I hope you found that helpful. We are going to shoot around a copy of the presentation off the back of this. We have a couple more events coming up in this series with the GA guys, so get around that as well. And yeah, please reach out if any questions. Cleo, are you there? Or yeah.
Thanks so much for presenting today's session.
Pleasure.
I'm going to share my screen again once more. So thanks again to the Pivot Wealth team for presenting today's session, and Ben for presenting today. And thank you you all for attending as well.